Welcome back, dividend and value investors. If you're new to this channel, welcome. I am European Dividend Growth Investor. Hey, in today's video I will give you my quick take on Ahold Delhaize's second quarterly earnings announcement from today. I will also run with you through some of the numbers and I will share with you what I think about what the company should be worth today. Guys, let's get started. Okay, so first of all, if we look at the price action from today, the company shot up by about 6 to 8%, depending on what time you were looking at during the day. Although, on a year-to-date basis, we're still 7.6% down. But, Ahold Delhaize, a company of a 30 billion market cap. I'll get back later to that. PE ratio of around 13 and a dividend yield of 3.37% before we went into this earnings announcement. Now, if you don't know Ahold Delhaize, really quickly, this is, let's say, the equivalent of Walmart or Target from the US. So if you're not from Europe and definitely not from Netherlands or Belgium, I can imagine that you don't know this company too well. However, it has also the Food Lion brand in the East Coast of the US. But if you want to know more about it, I did a deep dive also on Ahold Delhaize about a year ago. You can check it out. I'll go through all their brands, their earnings and everything and look really more deeply into what this company is about. But okay guys, let's get into the earnings report because it just blew me away. First of all, because we see this with all the companies, sales have increased, in this case 6.4% at a constant exchange rate to 21.4 billion. If we take the actual exchange rates into consideration, it will be 15%. Guys, this is huge, but of course we want to see it in the bottom line as well. Sales, however, were growing 7.7% in the US and 4.2% in Europe. Online sales grew 4.8% and grocery of that one increased by 11.5%. These are really strong numbers, guys. IFRS reported diluted EPS was 60 cents or their own EPS 59 cents. An increase of 11% year over year. I've done the numbers trailing 12 months. We're talking now about 2.26 EPS, which gives us approximately now a price to earnings of 13. In line with what it was already before, these numbers will be processed. So even with the price hike today that we saw in the share price, it really mirrors the growth in EPS as well. Having said that, let's go back to the guidance then, because this is really where it blew me away. It expects to mid-single digit growth in underlying EPS. Really nice, I would say. We're talking here about 5 to 6%. While they originally expected a decline or low to mid-single digits. So it's really an upgrade in their guidance. And also they expect an increase in 2022 free cash flow to approximately 2 billion instead of 1.7 billion. In my opinion, the most of this is being attributed to the currency exchange rate. So it's probably good to know. However, the cumulative group free cash flow guidance increased to 7.5 billion for the next 4 years. And I think this is also really important because we're talking here about 1.8 billion overall, let's say, on an annualized basis instead of 1.7 billion. So this is, I would say, quite good free cash flow, right? Last but not least, they're also suspending their intention to IPO Bol.com. I honestly feel really good about this. Last year, I would have loved to see them in the hype to spin off Bol.com. We would have probably get 50-70% more of it if we look at how the stocks crashed since then. Now it's not the good time anymore. I also see a lot of cross-pollination still possible between Albert Heijn, Food Lion, and the knowledge that Bol.com has gathered over the years as being a technology company. It has really allowed Ahold, in my opinion, also to do a lot with their online groceries. Last but not least, and this makes me the most happy as a dividend investor, a 7% hike in their dividend. If we look at the interim dividend compared to last year, it's now 98 cents based on the trailing 12 months. And with that, they spot now a 3.5 dividend yield. So I think this is really good, the 3.5 dividend yield, because if you compare that then to the Walmarts and the Targets of this world, it's a much better entry yield at the same dividend withholding tax of 15% for us as Europeans. Now, what I also then want you to still call out some little bookkeeping things. Free cash flow was 596 million, but you will see that if we look at the entire half year, it's actually a little bit less. Reason for that is you see a lot of companies at the moment with negative free cash flow because of the working capital adjustments. Ahold Delhaize had to do this already in quarter one. They got actually also punished for it at the time. Maybe it was even a buying opportunity, one could say. But having said that, that's why you see that the cash flow is a little bit lower, and still they are expecting 2 billion in free cash flow by the end of the year. Quarter 4 is usually a really strong quarter for the company because that's where all the Christmas sales are coming, high gross margin products. So expect the remainder of the cash flow really to come later. And of course, under favorable currencies. Now, what is more, I just wanted to call out 1, 2, 3 things still from the CEO comments. Net consumer online sales grew by 16% in the US during the quarter. This is huge. Food Lion continues to perform strongly, achieving its 39th consecutive quarter of growth and double-digit comparable sales. Remember again the Target and the Walmart earnings. They were being butchered in this quarter. I think, at least this quarter, Ahold was eating their lunch. It's really nice to see because usually we're blaming Ahold a little bit for poor performance in the US, and we often say maybe they should spin off the US business, which is approximately 60% of their sales. This quarter, actually, they have proven us wrong. They're really onto it. Now, what is then another highlight here, because we are all interested in this crown jewel, bol.com. Net consumer online sales declined by 2.1% during the quarter on top of 24% growth. So they didn't fall too much after this big COVID hike, which is good because what they say is that they are strongly outperforming the e-commerce market because it was estimated to have declined at a high single-digit rate. So this is really good news, I would say, and it shows just that it's a really strong asset. If we then also look at their own visual for the guidance, what I still wanted to call out here, a 2 billion free cash flow, right? 1 billion share buyback, and you need to know their dividends are also approximately 1 billion. So everything of this, the capital allocation, is covered by their free cash flow. But what I really wanted to say even more, 1 billion guys on a 30 billion market cap is 3.3% share reduction. They have been reducing their shares over the last few years by 15% if you take 4 or 5 years into consideration. We will get another share reduction of 3.3%. The dividend hikes are effectively paying it for itself, all else being equal. For me, this is the power of a high quality company, which is really well managed by this current CEO. One of my favorite CEOs right now because he uses this philosophy of under promise and over deliver. Okay guys, these were the earnings and the guidance, but let's now quickly go to my dividend dashboard. So really quickly, what I wanted to show you here, if you look at the cash allocation trend, right, the free cash flow is identified by the line. Yes, if you look at the trailing 12 months, free cash flow was 1.47, dividends 964, and the share repurchases of 1. So you could say they are over allocating a little bit, but we know that they are guiding for 2 billion. So this should be fine. If we then look at the balance sheet trend, equity is growing in the last 2-3 years in line with the debt. So nothing for me to worry there. If you are wondering why is this big bump in long-term debt here between 2018 and 2019, simply, that's when they started to take capital leases from an accounting point of view, also in the long-term debt numbers. Hence, don't be worried, it's accounting, all is good here. If we then go to my one-pager, I mean, it looks almost totally green here, as you can see. 15 years of dividend growth, 3.5% yield, 5-year average annual dividend growth of 11%, gives a Chowder rule of more than 14. 12 is the ultimate here, and it's even above that. So that looks really good. Payout ratios as well. Free cash flow could be a bit lower, I would say, but let's see how it develops in the next few years. Price to earnings of 12.4. I think a company like this should at least trade at a 14 or 15 multiple. So from that point of view, I still feel it's undervalued. Also, revenue growth 7%. Don't worry too much about the debt equity. This is a slow growing company with really predictable sales. Those kind of companies typically can take on more debt because their interest payments and such and their debt repayments are really predictable as well for the banks. So if you would benchmark this with industry competitors, it really doesn't look that bad. Last but not least, the value creation metric, something I really look into, is the return on invested capital is more than the average cost of capital, which means they are actually creating value for us. Having said that, guys, free cash flow, 1.7 billion. That's what I'm measuring with in general. 5% growth in the first 5 years, 3% thereafter, discount rate of 10%, terminal multiple 14, gives me a share price of 25.4. Guys, this is really good, but from that point of view, you could argue the shares are currently overvalued. But we can do a bit of fiddling with that as well if you want to do some scenario analysis here. So let's take that 2 billion will be the new normal. In that case, with the same numbers, all equal here, we will be talking about a fair value of 29.89 going forward. We know that they said 7.5 billion over the next 4 years. So if we would make this 1.850, let's say, which would be equivalent of approximately the average, you will see also that fair value will decline to 27.64. So guys, I've given you now 2-3 scenarios that you can use to model your own valuation or to pick from, depending on what you think the free cash flow is worth. I'm really a fan of the discounted cash flow model because the future cash flows discounted to today, in my opinion, the sum of that is what you should be paying for a company. Really easily. So from that point of view, you know what you can look at. I have already a large position in Ahold Delhaize. I believe it's my 4th one. I could still buy a little bit more, but I want to do it on a dip. In the past, my dip was around 22 euros. Based on these numbers, based on the increased guidance, I have no reason to doubt this CEO. He's always under-promising and over-delivering. I'm going to put my dip level now at around 24.50. So if it dips to 24.50, expect me to buy some more. At the same time, of course, I continue to reinvest those dividends. Companies going ex-dividend, I believe on Friday or Monday, I believe Friday. So once those dividends come in, I will buy some additional shares again from these dividends. Guys, this was it. If you like this video, smash the like button, subscribe if you haven't done so yet, and see you again.